The yield on US Treasuries has increased very rapidly this year, and we've also seen US growth stocks sell off sharply and value stocks rally to fill their place. But the question is, will that trend continue? Personally, I think it may well do, and in this video we'll look at the reasons for that. Now remember, if you do want to learn more about investing, a really good way to do that is as a part of our Patreon community. And you'll find a link in the description below me and beside me so that you can learn more about that. So now let's look at the increase in yields and what that means for investments in a bit more detail. This is not a recommendation. If you want advice tailored to your specific circumstances, seek independent financial advice. Let's start out by taking a quick look at US interest rates. Above me here you can see the yield on US 10-year Treasuries, and this graph covers the 2-year period from the beginning of 2019. Now at the beginning of 2019, the yield on 10-year Treasuries was above 2.5%. Then by the end of 2019, it had fallen to below 2%, and then once the pandemic hit, it fell again very sharply to around 0.7 or 0.8%. But this is what spooked markets recently, a fairly rapid rise of US 10-year yield to above 1.6%. Now in itself, that's not a bad thing. Generally, when we see interest rates rising at the longer end of the curve, that means that markets are pricing in greater growth and greater inflation. Now, of course, you'd expect greater growth to be a good story for equity because generally that pushes up earnings and that can push up stock prices. However, for growth stocks, it's not a great story at all. To see what I mean, let's look at the US equity market response to that increasing yield. The really rapid increase in yield kicked off around the middle of February. So what I've shown here are the response of various Vanguard factor funds from the middle of February to the beginning of March. And here at the bottom are the funds which have lost the most. So these big negative red bars you can see beside me are the negative returns for what did really well up to that point in time, which was growth stocks, momentum stocks, and small cap growth stocks. Rising interest rates are toxic for these types of fund. Theoretically, the reason for that is that they have a lot of cash flows projecting into the future, because those cash flows are growing very rapidly. If that's the case, then when interest rates rise, the value of those future cash flows is discounted very heavily, and that means growth stocks are particularly sensitive to rising interest rates. Or another way to see that is that during a crisis period, growth comes at a massive premium. And if a company can generate growth through a crisis, then you'll be willing to pay a very large premium for that company's stock. Well, as interest rates rose, that premium disappeared very quickly. And then these blue bars you can see beside me are the funds which did particularly well as yields were rising. And that's all the stuff that was really beaten up before that happened. So that would be US value stocks, but also small cap value. Now, US small cap value is historically an incredibly good performer. It's had massive outperformance for a very long period of time, decades in fact. But during this period since the global financial crisis, when growth stocks have done so well, small cap value has really suffered. So a lot of people have been saying perhaps this is just a head fake. We've seen value recover a little bit several times now, but it's never managed to sustain that outperformance versus growth. And if we look at US sectors, there's also been a big rotation away from the things which have done very well since the global financial crisis, and there in particular we'd be thinking about US tech stocks, and the rotation has been towards sectors which have been beaten up by the pandemic, but also by a recession. And that would be cyclical sectors like financials, and of course the energy sector was very hard hit as the price of oil fell due to a lack of demand. And really boring sectors like industrials and materials have also benefited as our activity starts to increase as we come out of this pandemic. And the question in our minds as investors is whether that rotation will continue. Will growth continue to flounder while value comes to the fore? Now personally, I think that may well be true, and this is why. I think the real game changer this time is the size of the fiscal stimulus in the United States. If we look at unemployment in the United States after the global financial crisis, you can see that it took almost 11 years for unemployment to fall back to 4.4%, which is where it was before the crisis hit. Now that's not because the Fed wasn't doing anything. Monetary policy, which is what the Fed controls, was very accommodative during that period. Interest rates were zero for most of that period. But what was inadequate was the size of the fiscal response. The government stimulated the economy just after the crisis hit, but then the stimulus was withdrawn and they started to worry about paying back the debt. People were worried about inflation rising very quickly as the Fed printed more money. In the event, that didn't happen at all. In fact, inflation was below the 2% target for a very long period of time, despite massive money printing by the Fed. And Claudia Sahm, who's the creator of the Sahm rule to detect US recessions, has recently written this article called The Path to a Recovery for All. And what she shows is that in the past, in 2001 and in 2007 to 2009, it took a very long time for unemployment to recover to previous levels. So in 2007 to 2009, you can see over this 4-year period it just didn't recover. And in 2001, although the recession was smaller, again it took a long time for the unemployment rate to fall back to reasonable levels. And what we saw in 2020 was a massive increase in unemployment. And that was unprecedented not just in scale, but the speed at which unemployment increased. So I think politicians have learned from previous recessions that unless there is very large fiscal stimulus, the government spending more, it can take a very long time if you just rely on the central bank to fix the economy. And what Claudia Sahm shows in this beautiful graph is how expectations of US growth have been continually revised downwards since 2006. Now, these forecasts come from the CBO, which is the Congressional Budget Office in the United States. And this dashed blue line is the forecast from 2005. It shows a gradual increase from where we were at that point in time for GDP. But then we had the global financial crisis, and then the CBO downgraded the US economic capacity to this dark blue line in 2010. Of course, the hope was that growth would be very large as we came out of recession and GDP would rise very rapidly to meet that blue line. So in 2015, growth had actually been very sluggish and it seemed very unlikely we'd move back to this dark blue line. So economic capacity was downgraded again. And then by 2017, actual GDP caught up with that 2015 forecast. But then, of course, in 2020, we had the pandemic and GDP got whacked again. Now, Claudia Sahm's point is that people have been too pessimistic about US growth. And what it would take to get us back up to reasonable growth in the US would be a very large fiscal stimulus from the government. And of course, a massive fiscal stimulus is exactly what President Biden has put into action. Now, the size of that fiscal stimulus is enormous. The American Rescue Plan will spend $1.9 trillion. And Bank of America has come up with a really nice statistic, which was tweeted by Carl Quintanilla, which is that for the rest of 2021, the US government will be spending about $880 million every hour. And the way we'd measure the size of the fiscal stimulus is to look at how large the budget deficit is as a percentage of GDP. Now you can see the US government has learnt its lesson and that the COVID stimulus is much bigger than the one for the global financial crisis. It's still not as big as the deficit we saw in World War II, but the fiscal stimulus is comparable with World War I. Now I'd strongly recommend you read Stephanie Kelton's book, The Deficit Myth, but this is the way she couches a fiscal deficit. And it is just an accounting identity. When the US government runs a deficit, in other words, they spend more than they earn, that money has to go somewhere. Where does it go? Well, it goes to the non-government sector. And that would be the private sector, so that's corporations, but also US households. So if the government spends $100 but only takes back $90 in taxes, then the non-government sector ends up with a surplus, and that stimulates the economy. Now, the problem with monetary policy is that it's the same rate for everybody. And what we've seen is that it's very bad at getting inflation to increase. What it has done is massively increase asset prices, equity prices, bond prices, and house prices. That tends to favour just the most wealthy people in society. But if we look at the effect on household income, and here the bars at the bottom are broken into deciles, with the richest households by income on the right and the poorest households by income on the left, you can see that the impact of this stimulus is much greater for poorer families than it is for rich families. Now that's really important because these poorer families are much more likely to spend every dollar that they're given than the richer families. And that means that the money spent by the government stimulating the economy is likely to be very effective. Many of the people who are given dollars will spend those dollars. And that means that this fiscal plan is likely to be very good at stimulating the economy and increasing GDP. And in turn, that's going to have a massive effect on interest rates and on asset prices. Next, let's think about how high interest rates will actually go. So along the bottom of this graph, I've plotted US GDP, and it's nominal GDP, not real GDP. And on the y-axis here, we've got the yield on 10-year US Treasuries. Now, the broad pattern you can see is that when GDP growth is very high, that's over here, generally that means that US 10-year yields are also high. And when GDP growth is low, as it is now, then US 10-year Treasury yields also tend to be low. And the red dot you can see above me is where we are now. We're in a period of low growth and low yields. But of course, if this fiscal stimulus works, we're going to be moving up this curve. So GDP will increase, but so will US 10-year yields. The question we're trying to answer is how far we'll move up this curve. If instead of a scatter plot, we look at the time series for GDP growth, and that's what you can see up here, it's the GDP growth going back to 1960, the period before the pandemic had an average growth of 4.1%. So if we were fairly pessimistic, just like the CBO, we'd probably say that GDP growth would go back to 4.1%. And of course, over that decade-long period, the Fed was keeping interest rates pretty much at zero. And the 10-year rate was also dragged down by the Fed's low interest rate environment. And it averaged 2.3% over that 10-year period. Now, I think the actual rate we might reach could be considerably higher than 2.3%. And the reason for that is that the fiscal stimulus is much more likely, in my opinion, to be successful in increasing inflation to the Fed's target. And if the Fed's dual mandate is then met, which is to have inflation average around 2% and to have full employment, then the Fed will be raising interest rates. So we'd expect to see interest rates well above 2.3% if that's the case. Remember, this won't be a return to what happened after the global financial crisis, when the fiscal stimulus was woefully inadequate. Now, what I've done here is I've plotted the 10-year rate for a variety of countries, including the United States. So we've got the UK in pink, we've got Japan in light green, and we've got Germany in dark green. And if you look at the most recent rates here on the right beneath me, you can see the US rates have increased very rapidly. They've also increased in the UK, but they're well below rates in the US. Whereas Japan and Germany are still at rates which are close to zero, or in the case of Germany, negative. So for investors in Japan and Germany, for example, it makes massive sense to buy US Treasuries. They can generate extra yield, and they can even currency hedge those bonds and still keep a lot of that yield. So if the US pulls ahead because of their much larger fiscal stimulus, then their yields will increase, but that will create a massive demand for their Treasuries from regions which haven't pulled ahead, such as Japan and the Eurozone. And if Japanese investors and Eurozone investors are buying US Treasuries, that will tend to push down US yields. So I think this will limit how far US yields can rise, because there'll be massive demand for US Treasuries from regions where rates are still extremely low, in the Eurozone and in Japan, for example. So let's say that US GDP does actually increase to 4.1%, which is where we were before the crisis hit. What would that mean for US 10-year yields? Well, if we slice this graph at the 4.1% point for GDP, that's the vertical line that you can see here, then the point at which it crosses this blue line means that yields would reach around 4.3%. Now, there's a massive uncertainty around that because you can see the points are very scattered here from historic precedents. But 4.3% is well above where we are now at 1.6%. So that suggests that yields may have much further to rise if this stimulus plan is effective. If that is the case, then how much will this affect US Treasury funds? So let's assume that yields increase just a little bit, and that's just to the 2.3%, which was the average in the decade following the global financial crisis. That's an increase of 0.7 percentage points. Well, if you have a short duration fund, like SHY, and that's the iShares 1 to 3 year Treasury bond fund, the duration of that fund is just 1.95 years, a multiplier of roughly 2. So if we have a 0.7% increase in yield, and I've assumed a parallel shift for the whole yield curve here, then we multiply that by -2, and we get a fall in the price of the bond fund by about 1.4%. So only a tiny decrease in the price of SHY. For a bond fund which buys the belly of the curve, that's the 7 to 10 year part of the US Treasury curve, the duration is much larger, it's about 8 years. So we multiply the increase in the yield by the duration, which is -8, and the price of the fund now falls by about 6%. And for the longest duration bond fund, so this is a 20-year plus maturity bond fund, the duration would be a massive 19 times. So this fund would fall by 13%. So none of these are catastrophic falls in these funds. They're significant, but not huge. But I think if the stimulus is really effective, then a yield of 4.3% could also be possible. And that would mean losses for these bond funds, which are much larger. So -5% for the shortest duration fund, but -50% for TLT, the really long duration US Treasury fund. Now, of course, this won't happen overnight. I suspect yields will gradually grind higher, and some of these losses will be offset by income on these funds. But still, if this fiscal stimulus is extremely effective, yields will increase significantly, and that's just bad news for bond funds. And it's also bad news for gold. Now, if you are a member of our Patreon community, you'll get access to our gold and silver fair price model. It's a very simple spreadsheet, but these are the two primary inputs to that model. The panel here on the top shows US real yield. During this recessionary period, it's been around -1%. But notice how recently it's been increasing very rapidly. Now, interest rates are toxic for gold. When interest rates increase, the price of gold tends to fall. And if Biden's stimulus plan is effective, that's going to mean interest rates do increase, and that's going to be bad for gold. The second input to the model is the strength of the dollar versus a basket of its trading partners. Now, of course, the dollar rallied because it's a safe haven currency as we first went into the crisis and equity sold off. But then as the equity market soared back into life when the Fed stepped in, we've seen the dollar weaken very considerably. But if, as a result of this stimulus, the US recovers ahead of the rest of the world, then interest rates in the US would rise, and generally that tends to strengthen the dollar. Now, of course, all commodities are priced in dollars, so a strong dollar means weak commodity prices. So again, I think this factor, a stronger dollar, will be bad for gold as well. So I've assumed that real interest rates will go back to where they were before the pandemic hit, and that would mean an increase in real yield from about -0.7% all the way up to +0.2%. And I've assumed the trade-weighted dollar would increase from 104, which is where it is now, to roughly 110, which is where it was for most of 2019. Now, if we feed those numbers into our fair price model, the fair price of gold goes down from 2120 to a number which is about 20% lower. But gold has been having a bad time of it recently, and in fact it's already at 1713. But I think what's pretty clear is that this paints a bad picture for gold. So I think this fiscal stimulus is going to be very effective, and it's going to make sure that these trends that we've seen in 2021, such as rising GDP growth in the US, rising yields, and a strengthening of the dollar, will continue for some time to come, probably well beyond the end of 2021. And if that's the case, then the outperformance of value versus growth could be a trend that continues for some time. But according to this Twitter poll from Eric Balchunas, I'm in the minority. You can see that 58% of people think that growth will continue to outperform value through the end of 2021. So in summary, I don't think this rotation away from growth towards value is something that's going away anytime soon. And that's because the root cause of the change, which is an improvement in growth, which drives higher yields, is something that's going to persist for some time. And that's a result of the fiscal stimulus which has been approved by US Congress. So remember, if you do want to learn more about investing and economics, a great way to do that is by signing up for our free weekly market roundup. I always try to keep it interesting, and hopefully you'll learn something from those weekly letters. And if you want to do that, there should be a link in the description below me and beside me. So, as always, thank you for listening.